Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. We have a huge episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are going to be covering some very interesting news to kick off the episode. Meta's new announcement, which you've told me do not look at. I want to talk about it on the show.
Yes.
The latest inflation figures. Then we're going to turn to a policy trial balloon that's been floated that is very controversial, and that is the Labor Party might look at negative gearing again. And then finally, to cap off the episode, something that the Facebook community have been clamoring for. You are going to reveal your portfolio.
Yes, off the back of you revealing yours.
Yes, but before all of that, we want to give a special shout out to our Brisbane listeners and community members, because we are coming north for one night only. We are going to be live at the Good Chat Comedy Club with Sam Gordon from Australian Property Scout. We're doing a live show. We're labeling it property or stocks. Can we settle the age-old debate, or is the debate overblown, and can we enjoy both? That's what we're going to be unpacking. The 24th of October, we would love to see you there.
That's it. Yes, cannot wait. Head to equitymates.com/events to grab a ticket. We'll put a link in the show notes. $30 and you can come and join us. Tickets did sell out very quickly for our Melbourne show. So if you want to come along and join us in Brisbane, make sure you jump on that. We cannot wait. Never been to Brisbane for Equity Mates. So
I was going to say, you've been to Brisbane.
Yeah, no, for Equity Mates.
You go to Queensland like twice this month.
Yeah, I do go a fair bit. But super pumped. But Ren, let's get stuck into it.
News and markets.
So last week, the Australian Bureau of Statistics, the ABS, released Australia's inflation figures.
Yes.
And at a headline number, Ren.
Great news.
Great news.
So the inflation target in Australia is between 2 and 3%. We've been in the high threes. The 12 months to July, we're at 3.5%. Well, good news, because the August number for the past 12 months, 2.7%.
2.7% last 12 months. That is, as you said, down from 3.5%. So the question then is, why is the RBA holding rates? What are they doing? Sitting there doing nothing? I think the important thing here is to actually look under the hood at what is driving this this inflation number. And whilst the headline is good, it's questionable whether it's a sustainable figure, because a lot of it is driven by government subsidies.
Yeah, one like cost of living relief subsidies. Yeah. The classic one is the $75 energy rebate, or like however much that energy rebate was that we got in the last budget. But then state governments also have their own cost of living measures. I wonder even if like the Queensland 50-cent public transport trial affects this.
Yeah.
There's a lot of things that state and federal governments are doing to reduce the cost of living, and the RBA has said that's great, but if it's not like a long-term sustainable policy, then is inflation really under control?
Take that away, and where are we actually at? Yeah.
And so Michelle Bullock has basically said, look,
I've closed my eyes on this.
but it's not going to mean a rate cut anytime soon.
Yeah,
so,
I think she explicitly said she's ignoring this figure.
Yeah. So I think like let's celebrate the good news. Let's hope that the trend continues, but let's not expect anything on the back of it anytime soon. And now I want to see these meta glasses that you're talking about.
Yeah. So before we jumped into the recording studio, I saw overnight that Meta have released what they call the most advanced glasses the world has ever seen.
Okay.
Now you remember, so we know that so we know that Apple have released their Vision Pros,
yep.
which, despite being big fat goggles, everyone is marveling over how amazing it is once you put them on.
Yeah.
Facebook tried many moons ago with Ray-Bans. Do you remember that?
Yeah.
Where they tried to do and that fell apart?
Like that. Facebook have had some success with headsets.
With headsets. What's it called?
The Quest.
Quest.
Yeah. But they've been doing stuff with Ray-Bans. Anyway.
But may I introduce to you what they call Orion?
Oh, they've introduced a new one.
Click the link and have a look at what they have. So while Ren clicks the link, they have released augmented reality glasses. So these are the world's best glasses. Just to paint a picture here, imagine Ray-Bans, but these frames, big, thick, black frames, thicker than a finger. These things are massive, and Mark Zuckerberg is standing there presenting these. Now, what you see on the inside, you have to look at the video. It displays very similar, I guess, to what Apple are trying, like multiple screens, and it overlays graphics and bits and pieces onto the real world.
So it's augmented reality.
Augmented reality, yes. But from the videos that I've seen, it's sticky, it's glitchy, and you have to wear a wristband so that so it can recognize what hand movements you're doing, so you can control what you're looking at with your hand, if that makes sense. So
honestly, the more I look at it, the more
I think they've missed the mark. I understand what they're trying to do. I think they're trying to get ahead of Apple here, obviously, with cutting to the chase of not having a massive headset and just being like, you could wear these in everyday life. But I think what you'll find is Apple 5-6 years down the track are just going to have the most elegant glasses that will supersede the Orion by far.
Maybe.
It's just another fascinating.
So and I'm just reading this article now. So to be clear, these glasses are not going to be for sale. They're prototypes that are going to be used at Meta.
Yeah.
But in theory, the idea is that they have a camera, a speaker, and a microphone.
Yeah.
And Meta AI will get the same inputs that we as humans get.
Yeah.
Like it'll be able to see, it'll be able to hear, it'll be able to talk.
Yeah.
And that's the long-term vision that he has, essentially.
Yeah. And don't get me wrong, I think the vision's right, but what he's just released, I just think, like, if you're going to release something, make it look good. And for me, this doesn't really sell it.
Okay, all right. Based on design today, would you rather wear the Apple headset or the Meta glasses?
Seeing how the Meta glasses operate, I would much rather go the Apple headset full stop. Like, I think that just the experience there for me is something I would much rather experience than what Meta have got here.
Yeah.
For sure. Yeah.
It makes me think...
But I can't wait for the future, let's put it that way. I want glasses that are as seamless as what I'm wearing right now, where, boom, in front of me, I'm interacting with a digital world on top of my real world. I reckon that would be awesome.
Yeah. I mean, it feels like it's happening. It just feels like Google Glass was...
I know.
So it was like 2013.
Yeah.
So it was like 11 years ago now.
Yeah.
And if you look up the Google Glass design...
It was all right from memory.
It was better than... the Meta one, probably. And that was 11 years ago. Like, think about how much technology has improved in that time.
Yeah.
And it had a camera.
Oh, no, I'm looking at it. It was pretty freaky.
Yeah. It was a lot more minimalist.
Yeah, very minimal. With a camera on one eye.
It was a bit more sci-fi.
Very sci-fi. Yeah.
But look, it's, it's funny to laugh at, but like we all, I think, see where it's going and want it, or are excited by the possibility. So it's kind of like, you gotta start somewhere. Yeah. I'm all for this.
Oh, don't get me wrong. I just compare how Apple release products versus Meta sometimes, and I feel sometimes Meta just like fumble onto the stage with a product and then work backwards, if that makes sense. I don't feel like they have the elegance of Apple sometimes.
Yeah. Anyway, watch this space.
Watch this space.
Yeah.
Ren, other news that's making headlines that we wanted to devote a segment to during from last week was the re-engagement of negative gearing from the Australian Labor Party, bringing it to the fore, potentially bringing it to the fore again as an election issue.
Yes.
They brought it in 2019, I think, lost the election because of it.
Well, yeah, they lost the election, and this was one of the big policy agendas that Bill Shorten had at the time.
Yes. The Australian Labor Party are considering going to next year's federal election with a policy around restricting negative gearing.
Yeah, now for people unfamiliar, negative gearing is when you are spending more on an investment property than you are making in rental income, and the difference between what you lose and what you make, you can claim as a tax deduction. Now, in the 2021-2022 financial year, 1.1 million Australians had negatively geared properties. Interestingly, our Prime Minister, Anthony Albanese, has a property that, at least from one sensationalised article I read on REA's website yesterday, is negatively geared. And I'm sure he is not the only politician that has a negatively geared property. Now, negative gearing has a long history in Australia. It was introduced in the 1930s as a way to address housing shortages. The idea was it would incentivise Australians to invest in property and boost the number of rental houses available. There was 1 year in the 1980s where we turned off negative gearing, and then we very quickly put it back on as a policy.
Did not know that.
Yeah, so I think that should inform some of the conversations today.
What, and was it quickly turned back on from an economic reason or policy, like political backlash? So I don't think ending negative gearing is going to have the effect that people hope it will. Yeah. And my reason is it's a sequencing mechanism. So 1.1 million Australians have a negatively geared home. Many have multiple negative geared homes. When you take off the tax benefit of negative gearing, as an investor, what's the first thing you're going to do? So you can no longer negatively gear your investment property. Jack your rents.
Jack your rents. And I think that's why they took it off in the 80s, and I think that's why we should be careful about how we talk about this policy today. Because in time, it would likely bring house prices down because investors wouldn't be willing to overpay. Like, they wouldn't be willing to negatively gear their property and lose money on it. So in theory, that takes some of the excesses out of the housing market. In theory, I know that is a contestable claim, but in theory, that's why people are saying we should do it. But that is the second order effect. The first order effect is that rents get jacked, and people try and hang on to their properties and positively gear them.
But is that not also in line with a dissuasion of new investors coming in? Like,
yeah. Well, it would,
and so I think but that would coincide. So it's not like existing supply. It's not like you're right. It's not like existing investors will sell immediately.
Yeah,
but
some would. But
some would. Yeah. But the incoming demand from investors should also pull back a bit.
From new investors?
From new investors, yeah. So I think that's some of the counter.
The thing is, like, there would still be new investors. It's just that they would only want to buy properties that are positively geared.
Yeah,
and
which we know is...
But you would see that would just like push rents up, because it's like the extent that which we can push rents up and keep properties positively geared or make properties positively geared, like, that's what we're willing to spend, if that makes sense.
I know what you're saying.
Yeah.
But I think we're so, like, imagine how much you would have to charge in rent for a positively geared house at the moment.
I know. Well, like, think about it in Sydney. It's like, yeah. It is a policy that distorts the market, and we should all wish that it wasn't that in the 80s they stuck fat and got rid of it and allowed the market to normalise. But unfortunately, that's not the situation we're in. Part of the reason why people think we should remove it is not only that it inflates house prices, but it also costs the government a lot of money. 2.7 billion in lost tax revenue in the 2020-2021 financial year. But look, this segment isn't just about us, Bryce. We went to the Equity Mates community on our Instagram. We put a poll up.
Yes.
And
if you're not following our Instagram, get on it.
Get on it. We said, we put a post up and we asked, should the government scrap negative gearing? We put 4 choices to the audience. Yes, scrap it completely. Yes, but grandfather it in for existing investments, so don't allow it for new investments. Yes, but limit it to a certain number of houses, and no, keep negative gearing as it is. 4 options. Have you looked at the results?
No.
Okay, so first of all, before you try and guess what the most common one was, what would you do?
Oh, what would I do? What would I do? I would grandfather it.
So you give existing investors a benefit at the cost of new investors.
Yes. I think that's the fairest way to do it.
Yeah. So that was the least popular option. 10%.
What would you do?
I get why that's the least popular option, because it would be the least disruptive option, but it would just add to that sense of injustice and unfairness. Oh, existing property investors who have already reaped all these benefits get another benefit and have an advantage over.
Yeah.
But I
get that.
I get the policy arguments why you would do it. It would be the least disruptive to the market. Because then existing rentals that are negatively geared, you wouldn't need to jack the rent up, but then you could allow the market to slowly normalise as those houses sell over time.
Exactly.
Do you want to guess what the most popular option was?
Just sack it.
No, the most popular option was keep negative gearing as it is.
What?
34%. Yeah. Second most
the Equity Mates community are all property investors.
Well, at least a third of them.
Keep it as is.
Yeah. Second most popular was yes, but limit to a certain number of houses. I quite like that as a phasing mechanism. It's like
what? Like four beddies versus three beddies?
No. It's like everyone can negatively gear 2 houses, and then in 5 years you make it 1 house, and so you allow the market to normalise over time that way.
Oh, but that's just still rewarding people that can afford 2 houses.
Yeah, of course. Yeah. So that was the second most popular option, 32%. Scrapping it completely, 23% was the third most popular option.
Wow.
So opinions were divided.
That's why it's a hot election issue.
Yeah. But I want to leave this segment with 2 key call-outs, because I think negative gearing is important to talk about, but I don't think it's the most important to talk about. I don't think it's had the biggest effect on house prices in Australia. The third rail of house prices in Australia, the one that no one is willing to talk about, but it has had the biggest impact, the capital gains exemption. I think there's charts where you see where that policy was put in place in the early 2000s and how it was a real inflection point for house prices. And especially you can see the chart where the median income to median house price ratio was pretty steady, and then it has a sharp inflection up in the 2000s, and that was a big part of it. It became much more of an asset to speculate on because of the tax benefits, and people could afford to over-leverage themselves and pay more. And so that's one that you could think about. Is there a way we phase that back in and you allow the capital gains benefit to increase over time?
Would you say the same for stocks then?
No, because the capital gains benefit is better for housing than stocks. You get a 50% discount if you're held for more than a year for stocks. Yeah. But for housing, your primary place of residence is just capital gains tax free.
Yes. True.
Yeah,
sorry. Yes, completely tax free.
So I would say, you could maybe you say if you hold it for
flip it. Give us stocks, guys. Some
you could see a world where you say 10 plus years you get that capital gains exemption. So it's not completely but that increases over time. But I don't think that would change the situation in the short term. What we want is to change the situation now. And I reckon, I've said this before on the show, but I reckon one thing that we could really look at, which would be really hard for pensioners, but would make an impact, is change the pension asset test. Because right now we have a policy set up in Australia where your primary place of residence isn't factored into your asset test for the pension, and so you can park you're incentivized to park as much wealth into your house as possible and buy as much house as possible, and then get the full pension. And so you have people sitting on a lot more house than they need, and there's no incentive to downsize, because as soon as you sell that, realize the gain, and then have heaps of assets, then you lose your pension or a large chunk of your pension. So I think that's one where it's okay, well, that could probably have an immediate effect. You'd lose it. You'd 100% lose the election, though. You wouldn't win.
I don't think that would have much more effect. You're just gonna move people from expensive houses to smaller houses. Then people are going to have to try and buy really expensive houses.
Yeah, but if you think of
that's not where I don't know how much effect that would have.
That's fair. Trying to bring solutions to the table.
Yeah, look.
I think the challenge is negative gearing, the capital gains exemption, the pension assets test. You're all dealing on the fringes of what is a it's like a fundamentally unsolvable issue
Yeah, I
at the
think
moment.
that's the crux.
Because it's like everyone's like, we got to build our way out of it. The government's big housing policy is 1.2 million houses in the next 5 years. They've got this housing future fund to try and do it. The challenge is we already, of all OECD nations, we build the second most houses per capita. Like we build a lot, and it's going to be hard to build more because we've got massive building bankruptcies. You know, like a lot of builders can't build more or are going out of business. And so then the conversation turns to population growth and immigration, and that's a difficult conversation in itself. But it's like structurally the way we're set up, changing the tax system isn't going to get the result that we want.
No.
In the short term.
No, between a rock and a hard place.
But the question for the Labor Party is, have people's views on housing changed enough in 6 years that what was a losing election issue in 2019 becomes a winning election issue in 2025? And based on the results of our Instagram poll,
No.
the answer is no.
Well, I think maybe with that policy view, with targeting negative gearing, but I would imagine if there were some other things that they came to the table with. But yeah, you're right. It's a tough one. The groundswell will definitely keep building until something will happen. But you know, anyway,
maybe, or it's just a situation where the groundswell is in people that don't own houses, but enough people continue to get into houses early enough in their lives. You know, it might not be in their 20s anymore, but it might be in people's like 30s and 40s, and then instantly they switch.
Yeah.
And maybe that'll be enough.
That's it.
And this Ponzi scheme will go on forever.
Anyway, we'll see whether they can actually bring it to the election or not, because they haven't actually announced anything yet.
No.
So let's join us on the Facebook. Join us in our Facebook community, yes, but also if you're not following us on Instagram, as you've heard, we're certainly having the conversations there and love getting your input as well. So Equity Mates is the tag. We're going to take a quick break, and on the other side, Ren, as you teed it up at the top, we're going to do, I'm going to reveal my portfolio.
Hell yeah, let's do it.
All right, welcome back to Equity Mates. A quick reminder that if you love listening to the Monday episodes, we do the exact same format and have the exact same conversation. Well, not the exact same conversations. We don't rinse and repeat. But Thursdays, we do all things news and views and many other segments that you enjoy on Mondays. So tune into the Thursday segments. But we're in. It's my portfolio time.
Let's do it. So, for context, a couple of weeks ago, I revealed my portfolio after the request from the Facebook discussion group. And after I did, there was a similar groundswell for you to reveal yours.
Yeah.
I mean, it's only fair.
Yeah.
So, take it away.
Well, I'm happy for you to lead any questions, but
all right. Well, okay. Let's start with overall portfolio construction.
Okay.
How do you separate your money?
So I split my portfolio. 70% is in ETFs and active management, and 30% is in individual stocks, alternative assets, and cash.
So a core and satellite approach, but for you, active management sits in your core.
I don't see it like that, but that's how it...
Okay, well, that's how you just told me.
Well, no,
70-30.
my core isn't, 70% is in ETFs and active management, and a core portfolio makes up part of that, if that makes sense.
Okay. So let's go. So when I explained my portfolio, I sort of said there were three. There was a core, and then active and thematic, and then like stocks and satellite. So it sounds like you've got a similar situation. Yeah. So let's start with your core.
So my core is 56% of my portfolio, and I have 4 ETFs.
Okay.
I've got 2 leveraged ETFs.
Yeah.
One is the BetaShares geared US equity, so it's leveraged to the S&P 500. And the other is the BetaShares geared Australian equity, and it is geared to the ASX 200.
Okay.
Both market weighted, both geared to 50 to 65% internally geared. So BetaShares manages it all. I'm not getting any margin calls. So those are my US and Australia exposure. And then I have an ETF that gives me Europe exposure, total Europe, VEQ, the Vanguard FTSE Europe. And then Asia is Vanguard Asia ex Japan.
Okay.
So weightings wise, they're reasonably similar. Almost 20% to the US, 14% Australia, 12 and 12 for Europe and Asia.
Okay, and that equals the 56%
That's
you were talking about.
56%.
Okay.
Yeah. So that's my core. And at this stage, about 90% of what I invest on a monthly basis goes into that.
Okay, so
That's
4 ETFs covering most of the world, and you dollar cost average every time you get paid or every month or something similar.
Done.
Yeah.
Yes.
Okay, so let's go to the second bucket, your active bucket.
Yes, my active bucket. Now, as you've heard on the show, I have a small cap manager, Fairlight Global Small and Mid Cap Fund. That's 6% of my portfolio. And I'm leaving my small caps to the professionals.
Yes.
Not
okay.
interested in index funds, not interested in, well, not interested, but every time I speak to the guys, I just love what they have to say and I trust them with my money. Then I have 2 active ETFs. I've got the Global X Semiconductor ETF, that's 4%. And I've got the BetaShares Australian Technology ETF. Now, I actually love this ETF.
Okay.
Its ticker is ATEC. It's all of the quality Aussie tech companies, minerals, and banks and whatnot.
Yeah, well, minerals and banks aren't.
No, I know, but it's like the top. So it's got 41 stocks. It's got Xero, WiseTech, Car Sales, Computer Shares, NextDC, REA, Pro Medicus, like all the good quality. Some arguably slip in there. You wouldn't kind of think of them as tech. But,
Okay.
And just to give you an indication of performance, the ASX 200 last 12 months is 15%. ATEC is 36. So yeah, I quite like that one. And I know Luke told me when we did it to get rid of it, it's like boring tech, but I strongly disagree that Australian tech is boring.
Nice.
Yeah.
Well, that's good.
Yeah.
All right, so 3 in that sleeve of your portfolio.
Yes.
And then the final sleeve is your more individual stocks and I guess crypto. So what have we got there?
So on the individual side of things, I have very few. I have been consolidating a fair bit recently, and I'm trying to get all my positions that I want over the 5% mark. But to run you through it, so I've got Alphabet is my largest single holding for individual stocks at 7%, Macquarie Group at 4%, Berkshire Hathaway at 2%, and I've just got on the bandwagon of Mineral Resources. It's at 2%.
Wow, 4 individual stocks.
That's it.
That's
Yeah.
it.
Yeah.
Okay.
So as I said, I did have a bunch more, but they were in the 1s and 2s, and I know I've got a couple here in 2s. I want to get Mineral Resources up there, and I'm just holding Berkshire mainly as a bit of a trophy because it's a Class A, and I just I just want to hold it.
Yeah. So Alphabet, Macquarie, Berkshire,
And Mineral
Minres.
Resources, yeah. Then to close out the individual stuff, not 6% of my portfolio is in Bitcoin, and then I've got 9% sitting in cash.
Okay.
Yeah.
So
Yeah.
Bitcoin's a pretty big chunk then.
It is, yeah. So it's not something that if it goes to 0, I'll be like, oh, no dramas. Like I'll be peaking.
Yeah. Yeah.
But I think how I'm approaching that is I just did a lump sum and I'm not adding more to it. And like I'm up on it. I'm happy I'm up on it and I'm just going to leave it. I might add a little bit more here and there, but like I'm not DCAing or anything like that. I'm just going to, it's just sitting there.
Nice.
Yeah.
All right.
Yeah, that's it. It's
So 4 core ETFs, 3 active/thematic, and then 4 individual positions.
Yeah.
Let's not worry about your crypto.
Yeah.
So it's only 11 positions in total.
Yeah.
That's
well,
very reserved.
Yeah, well, I think a couple of things, as I've said many times on the show before, I remember when we spoke to Charlie, he was a big proponent of fewer lines as possible as you're building solid positions. And so I sort of took that to heart. And I think, concentration builds wealth as well. So when it comes to individual stocks, that's how I think about it. Whether or not I'll add more to these, I definitely will Mineral Resources because I want to get that up there. But yeah, not just swinging at everything that comes by.
Nice.
Yeah.
All right. Well,
and it's hard to look at the performance of some of these ETFs and think that you need more.
Yeah.
That's
nice. Love it. Well, I mean, and the thing is you've got literally thousands of positions between all those ETFs and active managers.
Yeah.
Let us know what you think of Bryce's portfolio. If you're watching on YouTube, leave a comment. If you're listening, jump over to the Facebook discussion group and let us know. Let us know whose portfolio you want us to go under the hood on next. But that does bring us to the end of this episode. We'll be back in your ears tomorrow with another episode. But until then, if you're looking for something to listen to, we're very excited to share that Comedian v Economist is back. Thomas and Adam are breaking down the world of macroeconomics, having a bit of fun along the way. It is one of our favourite podcasts here at Equity Mates. And after about 6 months off, they're back. They're better than ever. And you should go and check them out. Or if you've enjoyed listening to them in the past, go and resubscribe because they have come back strong.
That's it.
But that's it for us. We'll speak to you next time.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.